Good morning and welcome to the Homestead CPA. My name's Dan Snyder. For those of you who are new to the channel, welcome. To those of you who've been here before, welcome back. Today we're on part 8 of a 15-part series about accounting, tax, and legal issues for homesteaders. Part 8, we're covering the purchase of a property, more specifically, how to allocate the purchase price of a property and why you need to do this. Now, without hesitation, I will say this is probably the single largest area that people miss and that advisors miss in trying to minimize taxes for homesteaders. And so let me explain what I mean by this and how you can help your tax advisor give you better results. If you have ever watched the introduction video to our YouTube channel, you will have seen a drone flyby of our property. You'll have seen the hay barn and the garden and the dairy barn and the house and some old oil tanks and some fences and the well, a number of other items that are on the property. Each of these may or may not be something that could generate a tax deduction. But if I walk into my tax advisor's office to get my tax return prepared and he asks me how I'm doing and I say, doing just fine, the wife and I bought a new house last year, the first question your advisor is going to ask is, well, what's the new address? So we can put that on your tax return. And so you'll give him the address. And he may even ask you, well, how much did you pay for it? And you'll tell him how much you paid for it. And he may make a note of that for future reference. Not that it's likely that you would ever have a gain, a taxable gain on the sale of your residence with the current joint $500,000 gain exclusion, but he'll make a reference of it nonetheless, just in case something happens further on down the road. So if that's all you tell him, that's all he is going to know. Now, there's a lot of difference between saying, hey, I bought a house versus, hey, we bought some property and on that property we have the following, and you give him a listing of the different things that you have. Some of those items may currently be an item that's subject to depreciation, which is the topic we're actually going to be covering next, and some of them may just be personal use. Also, because things change, some of them today may be of a personal nature, but they may be converted to a business use later. The important part is that when you purchase the property, you do an allocation at that time. So what do I mean by an allocation? When you buy a property, you just pay one price. So we paid about $400,000 for our property. Now that included 45 acres of land, an 1,800 square foot house, a 40 by 80 hay barn, an 1,100 square foot dairy barn, a well, about 2.5 miles of fencing, both external and internal fencing, and shades for the cows, old well, oil well holding structures. There's a lot of different things on the property. Now, you might say, well, why would I allocate a price to that? Well, let me give you an example. So our old oil tanks, we could sell those, and the scrap value of the metal would be worth $1,500, $2,000. Now, if we do that, and we have not allocated a purchase price, when we sell those for scrap metal, we would have to report that and potentially pay tax on the sale of that metal. On the other hand, if out of the $400,000 we had allocated a portion of that price to those tanks, then we would only pay tax on the difference between that price that we had apportioned and what we sold them for. So if we had allocated $1,000, for example, to those tanks and we sold them for $1,500, then we'd only have a $500 gain rather than $1,500. The same thing is true in many respects for the other items, but more importantly, you may have some items that, as I said, currently aren't being used for a business purpose, but may later become being used for a business purpose. So, for example, I have fence on my property. If I am just living as a residence on my property, I may or may not need a fence. So if I'm not using that in some sort of trade or business, there is no tax deduction for it. On the other hand, If I am raising cows on my property and I need that fence to keep the cows in so that I can make money selling cattle, in that case, then now I'm using that fence for a business purpose. When I buy the property, I may not have cows, but 4 years from now, I may decide I want to start running cows. 4 years from now, I'm going to need the information. So that's why it's important you do this at the time you buy it. And your advisor can help you identify things that may or may not be tax deductible. So for example, we have a concrete watering trough that's out in the middle of our property. That has water. How does the water get there? It doesn't just rain in it. There's a pipe that runs from the well all the way from the well. It's about 1,000 feet worth of pipe that runs down to that tank and fills it with water. Well, the tank has a cost or a value, but so does that pipe in the ground. So does the well. So do all the structures that are on the property. So out of, say, a $400,000 package of things that we bought with the purchase of our property, some of it is always going to be personal. Our house. So we have an 1,800 square foot house that the county, in its intimate wisdom, decided to value at $90,000. So we have $90,000 worth of house, and that's never really going to be a tax deductible item. But the remaining $310,000 could potentially be spread between the land and the various other items that we've discussed. Now, one thing that is not tax deductible and never is dirt. So the actual land, the acreage itself, nothing that's attached to it, just the land is going to have a value, and that value is not something that's going to generate a tax deduction. So let's say, using my previous example, that we had maybe $150,000 worth of value of land. Well, now we have $240,000 worth of assets that are going to be personal, that aren't going to generate any tax deduction. But what does that mean? That means we have $160,000 worth of value that may be attributable to things on our property that either currently or later could give rise to a tax deduction. And you might say, well, okay, fine. Well, what's that worth? Well, if you're in a trader business like ranching or farming or homesteading, something along those lines, then you're going to pay income tax, and you're going to add that income to the rest of your income. So you could be in a 10, 12, 22% tax bracket. But in addition, as a self-employed person, you're going to be paying self-employment tax. That's the self-employed person's version of Social Security tax. At the moment, that works out to a net of about 14%. So you could be paying upward of 36% on any income that you earn in your homesteading enterprises. So to the extent that you could get a tax deduction for that $160,000 worth of assets at 36%, you're looking at about $65,000 in tax savings. You're not going to get any of that if you don't tell your tax advisor what you have. So that's the reason why I say that you need to communicate with your advisors and let them know what you have. Now, there are some things that people don't normally think. Though I've talked about the obvious things, there's other things that people have that maybe aren't readily apparent. So we bought our property in the beginning of July. What did we have on the property? In addition to all those assets, we also had hay that it was about 3 feet tall, which we were able to cut. And we got about 200 bales of hay off of our property. Now, if we sold those 200 bales of hay, then we would have to report that as income. But we purchased that hay because it was already there when we bought the property. So out of that $160,000, a portion of that value we would attribute to the standing hay crop that is there. And you might say, well, yeah, but I'm not using it right now. You're not, and you may not be using it right now, but you may use it later. And so that's why you want to keep track of these things at the very beginning so that your tax advisor will be able to utilize that those costs and these expenses against your income at an appropriate time. But this is the one thing that most people, they don't think about, they don't know about. And to be fair to your advisor, if you don't tell him what you've done, then you can't really blame him for not asking you the questions. So anytime I know I have a client that is purchased a new property and they're in the ranching or homesteading or other business, most of the times I'm going to want to see it. And I'll have them drive me around the property, point out the things they see, and I can ask them questions. I had one client, we had 3,500 feet of underground pipe run for water out to the various pastures on his property. Have you priced putting in 3,500 feet of underground pipe into water your pasture? That's a lot of money. And so you can assign a significant value to these various assets that you have purchased, and in that way help minimize your taxes as you go forward. Now, when you sell that property, if you ever sell that property, you have to keep track of all of that, because some of these items may give rise to a tax on the sale. Some of them may not. You may never sell the property. In fact, you may pass this property down as an inheritance to your children or to your grandchildren, in which case no one may ever pay any tax on that, because you may get a step up in basis in the underlying value of those assets. And we'll be doing another video in the series on that particular issue later. So these are things that you want to do. Now, there may be some of you sitting there right now who are worried, oh my gosh, I've lost my chance. I've had this property for 2, 3, 4, 10 years, whatever. You can always do this. Okay, it's better to come up with these numbers before you actually need to start using them. So let's say you bought the property 2 years ago. You just didn't tell your tax advisor because you didn't think about it, and he didn't hear it, didn't think about it. You can go back and you can recreate these allocation of values as of the date you purchased the property. Then work with your tax advisors to see which of those assets maybe you're not using for business, which you may now be using for business. Some of them you may have started to use them to do business. Now, if it's been within the last 3 years, you may be able to go back and amend your tax return and in fact get some money back. So it's always worth having a word with your advisor about these things. And it's never too late to try and do the right thing, because it may be exceedingly beneficial to you. So I just want to thank you for being with us today. This is a topic that I speak about regularly, and I'd just like to wish you all a happy new year for 2025. And remember, even Jesus paid taxes.